By now, we've established how price moves, why liquidity matters, and how effort can fail, and also why markets alternate between balanced and imbalanced states. So, in this lesson, we're going to correct one of the most persistent and damaging habits traders have: asking the wrong question. And I know most traders look at a chart and immediately ask, is this going up or down? Do I long? Do I short? And I know those questions really kind of feel natural because you want to know what happens next. However, it always ends up leading to poor decisions because direction is not the first thing that market decides. Market state is. Market state answers a different question. What is the auction trying to do right now? Is it seeking agreement or is it searching for a new price? Those two objectives produce very different behaviors regardless of direction. So a market can move higher and still be balanced. You'll see rotations, overlapping price, and repeated rejections of that range extremes. Now, price may drift, but the auction is still negotiating. Direction alone does not define state. Now, an imbalanced market is a little different. Imbalances are not bullish or bearish, it is structural permission for price to move. So in an imbalanced state, one side has withdrawn willingness to transact. So now that liquidity is thin, resistance is reduced or completely gone, and price is now allowed to travel. So direction is simply just the outcome of that permission. This is why asking up or down too early creates a lot of problems because you start projecting outcomes before you understand environment or context. You start interpreting the effort on the screen without knowing whether that movement is even allowed. And again, if you're still just trading with candlesticks, you don't even see liquidity. So you don't even know if it's allowed or permissed. So once you start looking for confirmations where none exist because you have the environment and the context wrong, this is exactly why so many people are trading key levels and they get their entry model, but yet the trade still gets stopped out. So market state determines what behaviors are likely, not what outcomes are guaranteed. So again, in a balanced state, we're always expecting range rotations and we're expecting failed breakouts at the extremes of that range. And we expect that effort at the extremes to be absorbed. Very important. We will be using that a lot later on in our trade setups, in our system. Now, in an imbalanced state, we expect continuations or a trend, a push away from the range. And during this trend, we expect shallow pullbacks, and we expect price to seek new acceptance at a new price. These expectations have nothing to do with bias, though. They are mechanical consequences of the auction state. So this lesson exists to reframe how you read the charts. Before you interpret volume or delta or market structure, you have to answer one question. What state is the market in? And if you skip that step, every confirmation you see will be misweighted. Again, this is why so many people trading with just candlesticks and some kind of patterned entry model, yes, they can work, but they don't work when you're misweighting them. You're not understanding context and you don't see all the data that order flow software gives us. So by the end of this lesson, you should be able to describe the market without using directional language. It's not bullish or bearish, but we're looking to identify balanced or imbalanced. That shift alone will eliminate a large percentage of your bad trades. Now, here's the missing piece that most traders never learn about direction. Market state does not give you direction, it gives you permission. Once market state is defined, direction is no longer a prediction. It becomes an outcome of whether liquidity is granted or denied. So, liquidity is the permission slip. It decides whether a breakout is allowed or rejected. It decides whether a fake out resolves or it just eventually collapses. It decides whether a trend continues or stalls out. And it also decides if a range holds or breaks out and expands into a continuation. So this is why asking up or down too early is a mistake. And I know by going over what I just said, a lot of you SMC traders, and especially range traders, are already getting ideas of how you can use this to spot your reversals versus continuations. However, direction is not chosen first. Direction emerges only after liquidity either steps aside or holds firm. So, market state defines the environment. Liquidity determines what is possible, and direction is simply the result of that.